Welcome to Multifamily Method, a podcast which explores the state of the multifamily real estate market and some of the backgrounds, methodologies, and words of wisdom from some of today's most successful multifamily real estate entrepreneurs nationwide. We are very excited to welcome back one of our favorite guests, Jay Parsons from RealPage, Inc., who is a multifamily economist par excellence. And for those of you who aren't following him on LinkedIn, shame on you. Start following him today because he probably has some of the best content consistently posted on at least a weekly basis that I see. So definitely someone worth following in the industry to get some great updates and insights. Welcome, Jay. Great to have you.
Thanks, Mike, and thanks for the kind words. Glad to be here.
Absolutely. Absolutely. Well, before we dive into the meat of it, we're going to do a little bit of recap throughout this conversation from 2022, because boy, a lot has changed in multifamily. We stand here mid-June of 23 as of the recording of this podcast. And I thought it'd be interesting to go back and look at some of the things we discussed a year ago and then juxtapose that with the current environment that we're in right now. So one of the things we talked about a lot was rent growth moderation last year. And you were really calling that trend out, honestly, in advance of CPI, which we know lags a ton. You were really calling that out real time. And what are you seeing now in the market? And I'd really love to bifurcate it by A, B, and C asset type. Where are we at in June of 23 versus where we're at a year ago on the rent growth conversation?
Yeah, well, you're right. I mean, rent growth has moderated significantly, or was last year. And, now we're at a point where, it's a very mixed story. It's hard to really synthesize it into a couple of words because it's very fragmented. We're seeing rent growth year over year is down to the lowest level since April of 2021 nationally at 2.3%. We're also seeing now 8 markets out of the top 50 biggest metros that are now negative for rent change, and I think more are going to join that grouping. I think the biggest surprise to me so far is that the moderation is really becoming a little more significant than we expected. Our view has been that Class B and C are more insulated, and they continue to be. But I think what we're seeing is a little bit of a contagion spread where even though vacancy rates are lower in B and C, you're not losing renters to Class A. There's still a heavy focus on just filling units and staying highly occupied right now. And so that's led to more moderation than we expected in the B and C market as well, even again, despite better fundamentals. So that's been probably the biggest surprise. But flip side is the positive side is we're still seeing some markets where we're still seeing really good rent growth, especially in the Midwest and some of the Northeast markets as well. So that's been a little bit of a surprise because those markets are never seeing better rent growth than the rest of the country. So there's something different happening there, but also a lot less supply there.
Yeah, I'm actually intrigued by what's going on in the Midwest because, as you said, Jay, I'm not used to seeing Cincinnati and Indianapolis leading the way on rent growth. We're happy for our offices we have there at Capstone. But is that more of just a steady market that's not as high and not as low? What do you attribute that to?
Yeah, I attribute it to, it's like, there's periods in time where the tortoise beats the hare. And I think we're in that right now where, these slow and steady markets are now benefiting from being slow and steady. We didn't see the Columbus and Indianapolis and even the Milwaukees and Clevelands, et cetera, Kansas Cities, we did not see them see huge double-digit rent growth these last couple of years. They've been solid all along the way. And so, they've been able to maintain that pace. It's a little more sustainable pace, but at the same time, again, they just don't have the same supply pressures as we see on the West Coast or in a big part of the Sun Belt. And I think that's a positive factor as well.
Okay. Now that's a great point. In terms of where you see rent growth going, do you have any concerns? You mentioned it may continue to trend down in more than 8 of the top 50 markets. So do you see a negative trend in the near future?
Yeah, I think when you look at the next few months, I think there's a chance that we can get closer to zero on a national basis and maybe even slightly negative. And then I think from there it'll probably pick back up again, just because of when you look at year over year change, everybody looks at, you really got to look at what happened each of these months. And so we're going to be burning off some big increases from last summer, and likely replacing them with much smaller increases, even though rents are still growing. But we did see some significant rent cuts the second half of last year. And so again, that's why I kind of say it's a confusing story, because we may see rents go negative year over year, even without seeing any month over month rent cuts in 2023. But it'll really reflect cuts that happened the second half of last year and more moderate growth this year. So it's a kind of a unique story, unique situation that we're in right now. But ultimately, I don't expect to see significant rent cuts in most markets.
Okay. Well, you mentioned it's a fragmented story. So in terms of strength of market outside of the Midwest, are you seeing any other markets that are showing continually strong rent growth, relatively speaking, to that 2.3 national number?
Well, I mean, let me answer it a little bit differently. I think it's not just the rents. I think what's been actually the positive is the demand side. So that's been the real encouraging thing, is seeing that operators are trying to lease units. They have to compete for units, compete for leases right now. They have to compete to retain their residents. They've not had to compete for leases and retention since 2020. And so they're pricing to compete. They're being aggressive, and it's working. It's hard to say if it's one or the other, but it's clear, it's supply and demand at work here. And so the good news is that pretty much all across the country, with the exception of San Francisco Bay Area, we're seeing much better leasing traffic now. And really the leasing season has started off very strong. So that's a very good sign that we're seeing. That being said, the rent patterns are different, and so you don't see the lift that you typically see with strong demand. A couple of the exceptions, though, as you mentioned, is like the spots that are cooler are like places like San Francisco and Oakland and Sacramento, Northern California, and the West Coast. We're seeing Austin and Phoenix and Vegas that have cooled off quite significantly. They're negative. Tampa is racing really close to get there. Atlanta and Jacksonville, but on the stronger side, we're still seeing places like the Carolinas, Dallas, and even Nashville, somewhat surprisingly, holding up fairly well so far on rents.
Yeah, Nashville's an interesting one. And you had posted recently on LinkedIn, again, for those watching this after the fact, this is June of 23, about the supply being delivered in Nashville. And I was talking to our brokers about your very post a few weeks ago after it went up. And you know what they told me? Some of them been there 10 years. It's like, we've heard this story every year that we're going to get oversupplied, and somehow the people keep coming. The demand has remained strong.
Yeah.
Demographics just seem to overwhelm the supply there.
Yeah. No, you're right. I think that's been the case so far. I do think that I love Nashville. I think it's going to do great. I think that even Nashville is going to have some hiccups, especially downtown, because I think it's historically, we tend to overestimate the impact of supply, underestimate demand, as you said. But I think there's going to be a short-term mismatch, particularly in the downtown area of Nashville. It's you referenced the map that we showed, and anybody could find that on our LinkedIn page there. But it's pretty remarkable how much stuff is being delivered, and I think demand's going to catch up. But there may be a few moments there where rents do go sharply negative for a bit downtown.
Yeah, a little bit of competition there. Okay, as the supply is absorbed. So let's flip back to last year when we spoke about a year ago. As of June of 22, you saw 15% rent growth through that point of the year, and you predicted a 10% overall rent growth by the end of the year. So you predicted some moderation the second half of the year. How did 22 end up versus your predictions?
Yeah, that's a good question. 2022 ended up weaker than we expected. We saw sharper rent cuts in the second half of the year on a month-over-month basis than we expected to see. And that really was because demand cooled off more than we expected as well. Looking back, I really attribute that to some kind of an unprecedented event, because you had great job growth. It was the second best year for job growth since 1939. You had low unemployment. We had good wage growth. We didn't even keep pace entirely with inflation. And so what appeared when you look at it, really sticks out to me was consumer sentiment, consumer confidence. People were nervous. And when you're nervous, you tend to stay put. And that had a much bigger impact than I think anybody expected, because people weren't buying houses. They weren't signing new leases. They were just staying put. There was no housing demand for any type of housing, despite great job growth. We see those two are pretty correlated. And so with really weak demand, we saw vacancy rates jump significantly. And then we saw a significant month-over-month rent cuts. So we've kind of an exaggerated form of seasonality in the latter part of the year. We typically see some rent cuts, but we saw some pretty sharp ones. So that was, I think, a pretty moderate surprise last year.
Yeah, absolutely. And you had already mentioned maybe we end this year close to flat, around zero. Is that the official prediction where we end up in 23?
Yeah. We're gonna be revising our forecast at the beginning of July, and that will be ticked down a little bit from what we previously said, which was kind of I believe it was 2.5% to 3% range at the end of the year. I think that'll end up more in the 1% to 2% range. I actually think we could definitely be wrong here. I think it's actually going to be lower late summer than it kind of starts to come back up a little bit by the end of the year for the year-over-year rent change number.
Okay, that's great. So we spent a lot of time on affordability and what a hot topic that is, and you gave us good education on that last year. I wanted to talk about another related topic, which has been hot in the media, at least recently, which is this renters' bill of rights concept. So what do you see going on there, and what do you see as the impact on multifamily investors who are the people listening to this podcast?
Well, that's a hot question, and no one really knows the full answer yet. I mean, there's been a lot of negotiations on this right now, and and I think some productive conversations happening in DC between all parties, the activists and housing providers, as well as the policymakers. I think the thing that I think is most interesting to watch is around the resident screening. And this has become kind of a hot button issue. And really the question is around, how do you, one of the languages in the Bill of Rights talks about, the importance of providing safe housing, but there's also a lot of pushback on providing, things like criminal background checks. So that's an issue where I think we really need to see where that lands, because ultimately, you want to make sure your communities are safe for those who live there. You want to protect your residents, but there's kind of some pushback to how that should be used, and even some municipalities that are starting to severely restrict how background checks can be used. So that's one to really watch, because there could be issues there, even potential liabilities, particularly in certain markets. But a lot of it is really, I think, fairly common sense stuff. There's a lot of it that I think there's all the parties involved are pretty aligned on. I mean, you want to make sure, for instance, that people, that we honor leases, and that the leases have language that there's no kind of surprises in there. You want to make sure people are have access to things like, or at least have awareness to things like rent reporting for credit building. And so those are things where there's a lot of alignment on right now. And I think we could see, just some positive steps to make sure that, there's broader awareness of those things. But I think, there's some good things in there too, is the point I'm trying to make. Yeah,
I'm certainly a fan personally of allowing people to help their credit score by paying their rent on time. To me, that just makes a lot of sense, right?
So yeah, absolutely. Yeah, it's a win. And it's funny, I've seen some skeptics trying to say, the property owners, they don't want this because that'll send people into home ownership. It's like, no, that's like that. No, I've never heard anybody think like that. In fact, I always tell the Wall Street analysts, like, those guys grossly overestimate, that as even a factor. It's like, apartments tend to do well when the homeownership market is strong. In fact, homeownership's gone up these last few years, even with all this rent inflation. So, that's not a boogeyman that property owners are scared of. In fact, like you, I think it's a win-win for everybody.
Yeah, agreed. That's great. Well, I also want to talk about something that I don't think we covered last year, which is the build to rent space. It's the new horizontal multifamily, call it what you will. It's certainly every conference I go to, every group of owners I speak with, especially developers, Jay, they're very intrigued by the space, and a lot of capital is pursuing the space right now. So could you give us a little bit of an overview of where we stand today with build to rent? And then where do you think this thing is going from here?
Well, I'm a big fan of build to rent. I think there's a lot of runway still left. Everyone gets I've seen some nervousness about it because of the volume of supply, but it's still a drop in the bucket in the big picture. This is a pretty new sector. Build to rent to me is feeling a natural gap in the rental market, because you got apartments, and then you jump to single family, but it's there's an opportunity, I think, that's being met for this niche where you have people who've kind of outgrown an apartment. They have kids, they're older, they want more space. Maybe they're building a house and need a temporary situation, or maybe they move to an area and want to have all the amenities of an apartment community without having shared walls and living in a traditional apartment, going up the stairs to your unit, all that kind of stuff. And so that's where build to rent really fits a great niche. And I think it's got a lot of runway left. There's gonna be areas like in parts of outer Phoenix, for example, we're building a lot of it. There's going to be some short-term supply demand issues, but long-term, I think there's a lot of runway here, and it's been a natural kind of extension for multifamily as well. We're seeing multifamily investors and property managers being able to easily extend their platforms into build to rent, which is much harder to do into scattered site single family. So it's a way to get to the single family rental demographic without having to get, how to acquire all of these individual sites and how to manage a scattered portfolio. It's a much easier transition into single family.
Yeah, and I would argue not only are there economies of scale by rolling it all up into one project, there are enhanced amenities for the tenants. So, I mean, you get your clubhouse, you get your pool, your tennis courts, or whatever the developer decides to put into that, which you don't get with a scattered site rental portfolio. So there's value there on both sides of the equation.
And the centralized management. I mean, it's nice having the convenience of you got a maintenance issue, you have a maintenance team on site that's right there. And all of those things are, nice things about being in a community. And also too, you're with fellow renters who are probably in a similar life situation as well. And, there's a natural kind of built-in community aspect with build to rent.
Yeah, that's a really good point. I hadn't even considered that, but that's very true. Okay, so inflation, the Federal Reserve is talking as we're talking here today. Whether they fire another 25 bips this month or next, I don't know. But what are you seeing in terms of income versus inflation trends? Because last year, and you touched on this briefly a moment ago, the income continued to rise above inflation, which is kind of a spiral, right? So what are you seeing going on this year in terms of that relationship?
Yeah, I mean, that's a good question. I don't have a crystal ball, but I think I do believe that inflation's coming down. I think we've turned a corner, and the question is at what degree, and how much more the Fed chooses to raise rates to intervene. And obviously, as you alluded to, the concern is a little bit on the job market. But there's been some signs that the job market is seeing some issues. I mean, I think everyone's kind of amused at this point. Every month, it seems, you got headlines about layoffs at a company, and then the next day, the latest data comes out saying that, job growth exceeds economists' expectations. Like, I was telling somebody the other day, like, I wish we can compile a list of all the headlines from the jobs release every month for the last, 3 years, or almost 3 years at least. And I think everyone is pretty much saying the same thing with different word choices. So that does put the Fed in a little bit of predicament. But I'm generally optimistic. I just think that we're going to be seeing more of an impact, here in these next few months. So I think that even wage inflation will be coming down further, and we're seeing that in apartment data. By the way, we're seeing that new renters moving into apartments are coming in with some income growth still, but it's not nearly like what we saw last year. And I think that's a pretty telling statistic as well.
Yeah, that really is. Well, if Jerome Powell decides to listen to this podcast, Jay, my advice to him, give it some more time. I think it's abating. We'll see. Okay.
Yeah.
Let's talk about.
I hope he doesn't raise rates more, but he's got a bigger job and he's smarter than me, so I can't be too judgmental, I guess.
I share the same sentiment. Hopefully, they just let this thing ride out and hold the line. Most of us on this interest rate discussion, I think most people you talk to are predicting there's maybe one more 25 bip hike, but at a minimum, there's a moderation to this curve up in interest rates, right? The 500 bip jump in the last 18 months seems to be primarily done, that we're almost at the end of that. So what do you see in terms of impact on cap rates as well? I know the two aren't completely intertwined. However, cap rates have risen in multifamily in the last year. We're certainly well aware of that as an investment sales firm. Where do you see that playing out the rest of the year?
Yeah, as you said, there's not been a clear relationship between interest rates and cap rates, but and let me also caveat this by saying that no one really knows what's going to happen with cap rates. So let's give you my best guess. I think what we'll, as you said, we've seen some cap rate appreciation. I think we'll see a little bit more, but maybe not as much as some want to see or expect to see. And that's just because there's still a lot of investor demand for apartments. And the other part of this too is I think a lot of investors, more than anything, they just want stability. They want predictability. And so if they know that, okay, rates are going to be around here, interest rates, I should say, the cost of debt is going to be roughly here, they can start to work around that and make these deals work. And they have to raise some additional equity. But most sellers are still going to be in pretty good position. They don't have to sell at panic prices. That's going to cap how much cap rates going to go up. And you're going to have some distress sales hitting the market. And that may skew some of the numbers a little bit, but that's going to be, I don't think there's going to be as much of that as people expect to see, especially second half of the year. So I think those factors combined are going to keep cap rates fairly close to where they are today, maybe just a little bit higher. Yeah,
I think that's a really good perspective to have. They certainly haven't trended along the same direction. And there's a pretty good argument to be made. I know Peter Linneman always makes the argument that it's more related to the equity in the space than the interest rate anyway. So maybe that's the more correlative factor. Time will tell. All right, so we talked a little bit about construction delivery and markets specifically around Nashville, but are there any other markets? I know you've been publishing some research on this that you're keeping your eye on in terms of new delivery and what's to come down the road for absorption.
Yeah, I've been trying to tell people it's not just, people, you mentioned Nashville, we talked about Nashville, but I've saw that, even the Wall Street Journal had a headline last week saying, the Sunbelt supply. And I've been trying to tell people, I was like, look, it's not just the Sunbelt. Yes, there's a lot in the Sunbelt. It's Nashville, it's Atlanta and Charlotte and Austin and all these other places and Orlando, et cetera. But it's also, and Phoenix, I keep going on, but it's also Seattle, it's Los Angeles, it's Columbus, Ohio. It's all over the place. And I think especially when you look at the places where investors really want to go, even if Los Angeles is a great example of this. So you could say, okay, well, Los Angeles's supply expansion rate is still below average. Well, if you look at the entire rental market in Los Angeles, that could be true. But a lot of LA is more of a mom and pop, small multifamily market. You look at where most of the construction's going, it's where most of the private equity institutional capital and REIT presence is, which is downtown, mid-Wilshire, and West LA, Hollywood. And those areas are getting a lot of supply. So we're really tracking all these spots, and there's very few areas that we think are insulated. I think it's not so much a market story as it is a sub-market story. And you look at most suburbs are not going to be as inundated with supply as most urban neighborhoods.
Well, and that kind of begs a question, right? So you said last year, and this has really proven to be very accurate, Jay, that suburban Class B is very safe for a couple of reasons. One, the supply isn't there, but B, the spread in the rents versus Class A is too great for people to make the leap.
Yep.
So do you continue to see that as a preferred, rather protected asset class going forward for investors?
Yeah, no, I do. I think I would just, I think, again, going back to what I said earlier, I'm a little surprised how much the I would say the contagion has spread to Class B and C in terms of rents. Just the fact that they're cooling across the board, despite, again, like, we're seeing good rent collections, we're seeing, good demand. You're not building at those levels. We're not seeing any evidence of move ups from Class B into these lease ups. So, all that being said, like, I do think these sectors are better insulated from all the supply. I think they're going to hold up better in the long run. But I do think there's clearly been a little bit of, that bug tends to spread, though, nervousness about the market. And so it's not fully insulated, but I think it is better protected.
Okay. That's great. Let's talk a little bit about expense growth. We're definitely hearing a lot about that, and we have a very active team in Florida and your markets in Texas, and we're just hearing, especially coastal insurance is just burning people up right now. But in terms of expense growth, what have you been seeing, and what trends are going on right now? It seems like a very hot topic for most owners.
Oh yeah, and I don't remember, I may have said this previously, but I've kind of become a standard joke of late, is that, like, I've been in this in the real rental housing research role business since 2009, and this last year, 2022, was the first year that was ever really talked about expenses. And I'd meet with a lot of our clients, owners and managers, and they'd be, we do a lot of meetings at budget season, which is kind of late summer through fall, and nobody ever talked about expenses until this last year. And so now, as you said, it's one thing that's really interesting to me is how much expense inflation has really trailed rent inflation in this cycle for apartments. And so apartments benefited from the rent run up in 2021, early 2022, but then they started to see rent moderation with expense inflation in 2022 and now 2023. So that is a massive challenge, because the issue is now, especially for someone who's a newer buyer who didn't benefit from that run up, now your expenses are way above pro forma and your rents are not keeping pace with that. So that does become a little more challenging. And it's not just, you mentioned insurance. NMHC just had a report last week showing, I think it was 26% increase annually in insurance rates, insurance premiums across the country. And it's especially bad, like you said, it's Florida, it's Houston, Southern California, where there's been some energy grid issues, wildfires, et cetera. So but it's happening everywhere, and it's not slowing down. And beyond insurance, it's maintenance, it's payroll, it's utilities, and of course property taxes are a big one also. So this is a real challenge right now, and there's a big focus on expense control.
Yeah, we're definitely very active in that conversation as well. Everyone's looking to improve the NOI, and without the top end rent growth, you've got to focus on the operating side a lot harder, right? So, well, tell us a little bit about what you've been up to at RealPage recently. Give us an update there, what you've been working on.
Oh, wow. Well, my job is a lot more fun when the market's changing a lot. And so that's what, it was pretty boring in 2018, 2019. It's been much more exciting these last few years. And so, a lot of what we're trying to do is we have a great team of economists and analysts, and we're just trying to do what we can to keep a pulse of what's happening, and also trying to advise our clients in different parts of the industry on how to navigate through it. So it's been interesting, that's for sure.
Yeah. Well, I said at the beginning, but if you're not already following Jay on LinkedIn, you should be. I know you guys also do periodic updates and market updates with your colleagues there, which I also enjoy. Are those on a quarterly basis, Jay?
Yeah, so my colleague Carl Whitaker and I host a quarterly national multifamily update, and Carl and his team also host a weekly series on individual markets and regions across the country. So you can find that at our website, realpage.com/webcast, I think. And there's a whole bunch of them you could follow and they're all free, so you can feel free to join those.
Yeah, I'd encourage all our investors listening to the call to jump on those as well if you want some more information and insight from Jay and the team. Well, Jay, thanks for your time. You've been gracious as always, and have a great day.
Thanks, Mike. Thanks for having me.
Multifamily Method is powered by Capstone Companies, the largest privately owned multifamily investment sales brokerage nationwide. Capstone Companies provides dedicated coverage to both primary and secondary markets throughout the Southeast, Mid-Atlantic, and Midwest regions of the United States. Whether buying, selling, or refinancing, Capstone Companies is here to help. Simply put, Capstone is expertise, experience, extra mile. If you're interested in having Capstone provide a complimentary opinion of value on your multifamily asset, please visit us at capstone-companies.com. Thank you for listening to Multifamily Method. If you enjoyed today's episode, please give us a rating and a review on Apple Podcasts. It helps our podcast get discovered by other savvy investors like yourself. Subscribe to Multifamily Method for free on your podcast platform of choice. Find out more about Capstone Companies at capstone-companies.com. Multifamily Method is executive produced by Capstone Companies. Audio production for the podcast provided by Andy Go of Gojo Studios, and video production by Yash Mistry of Mystery Projects.